you so much, and it's great to be here. So today we're covering off asset mix. So what drives the percentage of fixed income and equities in your portfolio? So we'll touch on a few key areas that play a critical role in what drives that percentage of asset mix between fixed income and equities, such as portfolio allocation. We'll dig a little deeper into a few of those components, the need for diversification, and also we'll touch on some other asset classes and when they would make sense and be considered. So we're living in a world of polarization and contrast, and that's reflective in our current economic environment. So, as an investor, it can be difficult and confusing to try to revolve your goals around all these moving parts. Now, a few slides will cover my approach to portfolio positioning. But in order to feel confident and in control, we must ask ourselves, how do these moving parts affect me as the investor? And how can I best position myself to take advantage of that? So similar to a portfolio analyst, taking um, taking a deep dive into research on a specific company, we need to do the similar work for ourselves in understanding who we are as investors. So we cover off areas like your investment knowledge and experience. And experience plays a role in a few areas. It's not so much about the experience you have perhaps in your field of work that has to do with investing, but it also has to do with your experience of just being an investor and having had that time to be in the markets and see and feel that volatility that goes with it in terms of your strategy. And when you're getting that quarterly report in and you're seeing your amounts change from quarter to quarter, you have to really take a step back and think about how you're feeling at that point. Are you committed to the long-term goal? And if it doesn't really phase you in terms of the fluctuating amounts, then you know that you've built up a level of experience to understand that the markets have cycles, and we are part of that cycle. Now, the investment side, the time horizon, also plays a role in terms of how long do you have to invest in order to meet your goals. And understanding your goals and the purpose of investment plays a huge role in staying committed to that strategy, even when it feels tough, even when it feels like maybe I should sell, maybe I should just sit in cash. So you need to understand the long-term goals and what that means. Your overall financial position plays a role in how much exposure to different asset classes makes sense for you. And all of this is an ongoing journey in terms of how you develop, how you grow your wealth over time. And other components play a role like tax consideration over time, the size of wealth that you have to invest, and other unique circumstances. So once we know all this, we can take a look at suitable approaches in assessing your benchmark and the range of portfolio allocation. So the different types of risk profile scoring, which in fact really should be called volatility scoring, as the measure of your comfort level and the ability to accept that level of volatility in order to achieve certain long-term returns. So the automated scoring, it's best suited for those who are starting out, perhaps have a small nest egg, or starting with monthly contributions. The general outcomes best identify the investor profile that you could be, and will identify suitable asset mixes within those ranges. The manual questionnaires ask similar questions with the ability to capture extra information regarding special tax consideration or unique circumstances. Now, this type of assessment is best suited for investors looking to incorporate perhaps more than one goal, and are still fairly simplistic in terms of their overall financial positioning. Now, skilled advisors like myself, through lines of questioning and assessments, are best suited for high net worth individuals, which allows for um, more custom analysis that incorporates a total wealth approach where we can identify specific needs and specific strategies and run certain strategies simultaneously and also assign specific benchmarks to each one. Now, looking at a personal benchmark, it's important to understand and assign a personal benchmark to specific goals in a way to measure your success. So if we use a retirement goal as an example, for an investor that's at or near retirement, we can say that that immediate need is there to provide a level of income to support your lifestyle. Now, that level of income is needed, and it's reflected by that depletion rate that measures how long your money will last you. Now, the depletion rate becomes your required return, where it's that minimum return needed to meet your goal and maintain that investment for as long as possible. Now, if we look at that same goal, but we are 25 years away from retirement, we can say that that retirement goal is essentially our aspirational goal in that goal based pyramid. We need to determine what amount is needed to trigger our decision to retire in 25 years. And the measure to success becomes our desired rate of return, which is a nice to have return. However, it leaves room for some adjustment. Now that we've established our ranges of volatility and personal benchmark, we can construct an allocation needed between fixed income and equities for our portfolio. So these are three basic examples of portfolio allocation. And looking at these examples, we can assign an income-oriented objective to someone that's looking to achieve their immediate need or obligation. So again, using the example of if you're in retirement and you need that portfolio to produce a level of income to help support your lifestyle, we typically would structure a portfolio that has more emphasis on fixed income, where the main objective is to provide and produce a level of income um, in order to keep that sustainability going. Now, a portion of that, we can also incorporate some equities where the equity portion meant to be there for the longer term can take on some extra volatility. However, it's there to be able to help accelerate some long-term growth, to be able to meet inflation and at times beat inflation to keep that capital preservation piece going. Now, if we look on the other side of that spectrum, a growth-oriented mandate, which we would typically tie to an aspirational goal, would have a much longer time horizon. So within that 20, 25-year period, for instance, where you're able to take on a higher level of volatility because you do have a lot longer to participate in several market cycles. And that, at the end of the day, gives us the opportunity to try to earn a higher rate of return. And we keep a smaller segment within fixed income just to keep that piece almost like a bolster and a buoy to have a small segment where it's somewhat consistent, somewhat safer, can produce a regular income. However, the overall income objective is not the main objective, it's more geared toward growth. Now, the middle of the road type of portfolio, which we look at it from a priorities, desires, and belief perspective. We can easily assign that to individuals who have young kids. Maybe you're 7 to 10 years out from having them go to university. This type of portfolio gives you a great balance between focusing on assets like fixed income that earn a regular income, and also pay that income into the account, which can then be used to reinvest in the portfolio, reinvest into the assets and other units, in addition to your regular contributions into the fund. The other half of that portfolio is geared toward that longer term growth, participation in the stock side of the market, and be able to achieve that higher rate of return that essentially meets or exceeds that level of inflation to keep that portfolio growing preserve it, and over time, so it's important to note that these asset mixes aren't set in stone. They're meant to shift and reflect over time what your goals are doing and what your trajectory in life is. So over time, specifically with this middle of the road type of portfolio, this it would typically become more conservative into the income objective the closer you are to needing to withdraw funds to cover off the expenses for school as an example. Now, needing diversification is very important, and looking at not so much the diversification between what's our split between bonds and equity, but if we dig a little deeper into diversification, we also need to understand that within those specific asset classes, we need to diversify ourselves and have different components work for us at the same time. So Harry Markowitz, an American economist, devised a globally recognized theory called the modern portfolio theory. It's a staple in her industry. It's something that we learned in textbooks for decades. It talks about the emphasis of portfolios, risk, correlations between securities and diversification. And at the end of the day, we look at it from a perspective of diversification, aiming to minimize the risk or essentially the volatility of holding assets that move in the same direction. So when we're looking at correlation, we want to be able to hold things that don't move in the same direction at the same time. So when we're looking at portfolio allocation from an asset mix perspective, typically we want to hold a mixture of stocks and bonds because when we're capturing gains in one asset class, it's typically there to offset some losses in another. And diversification in specific asset classes like equities, we hone in on different components like the different sectors in the market, different markets themselves, like understanding and participating in different countries, companies. So looking at that, ways to diversify, and I'm using the Steinberg Global Value Equity Fund as an example, where it's an all equity mandate. We can take a look at the different geographic allocations from that portfolio and the different investment strategies there. And it's important to note that we are in Canada. So from a Canadian perspective, a global mandate includes not only the US, but also the other countries, internationally recognized countries in the world, like the UK, France, Japan, Hong Kong, to name a few. On the other side, we have sector allocation, which again, it gives us the opportunity to participate in different areas of the market, like information technology, financials, healthcare, consumer discretionary, industrials, and materials. So that gives you a good makeup of the ways we can diversify. And essentially, diversification, I think we've all heard the term, don't put all your eggs in one basket. Well, here you go. We typically like to spread our opportunities where we can find them. Now, touching on other asset classes, we take a look at that from a few different areas. So other asset classes can deliver different exposures and opportunities that aren't present in traditional asset class solutions. We see here that this is not an exhaustive list by any means, but there's opportunities within private equity, real estate, and private debt as other solutions to help enhance long-term return. These typically can be illiquid in nature, could require longer lockup periods, and also in some cases, that level of wealth that's committed to these strategies is often otherwise not going to impact the investor's overall wealth position or financial well-being. So these are different opportunities that can take place for different investors that are driving that need for a level of diversification or something different outside the traditional asset class markets. And they're typically bigger in nature in terms of the overall amount that they can commit to participate in certain strategies of this size. So that basically concludes, in a nutshell, at the end of the day, the asset mix and what drives different components of what drives percentage of fixed income and equities into your portfolio. So I think we have some time here to cover off some questions. I think we have here a question. Are both bonds and equities a requirement or a recommendation? That depends. So again, if you're looking to achieve certain goals and certain results with your goals, typically we would look to have participation within bonds and equities as it makes sense to your own situation and your own ability to take on that level of risk. Here's another question. When people talk about their portfolios, does that mean their asset class, or sorry, their asset allocation across all their investments or in a specific account? Again, it depends. So some people do talk about their investments as a whole, and they talk about, and they will typically highlight what's working for them or what's not. You can have a different asset class specific to different accounts. Like your RESP could have a different asset allocation depending on the goal, and far different than your RSP, which typically would have a longer time horizon. So I think we're almost at the end of our time here. I wanted to thank everyone for joining in today and allowing me to speak and share my thoughts on asset mix and portfolio allocation. If you have any questions, please don't hesitate to connect with me. I'm here to answer any questions and help in any way I can. Thank you so much.
Thank you.